So when we talk about intragroup dividends, the parent will always be a shareholder of the subsidiary, even if the shareholding was not the method by which control is obtained. Therefore, any dividend or part thereof declared by the subsidiary will accrue to the parent. This dividend declared by the subsidiary represents an intragroup transaction, as we've already mentioned, and must be eliminated with a consolidation journal entry. Just to make it a little bit visual again, I have my parent gaining control over my subsidiary. And as I've mentioned before, the group forms represented by my red block. Now, the parent is an equity participant of the subsidiary. What if we have NCI? Then my non-controlling interests are outside of the group, or also an equity participant in S. So what's going to happen with regards to dividends? If the subsidiary declares a dividend, who gets that dividend? There's a portion that is declared to the parent and a portion declared to non-controlling interest. Which portion will be intragroup? The portion attributable to the parent or the portion declared to NCI? And your answer is what happens inside the block. The portion of the dividend declared to the parent will be the intragroup dividend to eliminate. But we also need to talk about the portion of the dividend declared to NCI and what would happen to the NCI balance as a result of that dividend declared. The first scenario I want to look at is where we have intragroup dividends and it is a wholly owned subsidiary. So I'm not looking at the effect on non-controlling interest yet. I'm first going to take you through an explanation behind the consolidation journal entries that will be required, and at the end I'll do a little example using amounts. First of all, the journal entries you see in front of you are consolidation journal entries. We now assume that the separate financial statements of the parent and the subsidiary, which is my starting point, includes all the dividend transactions as it has been and had to be recorded. The first scenario, wholly owned subsidiary, and the dividend was only declared and not yet paid. So now we need to think what are the transactions and balances coming through from the separate financial statements of the parent and the subsidiary that I have to eliminate. First of all, consolidation journal entry for the dividend income recognized by the parent and the dividend declared by the subsidiary. Dividend income was recognized as a credit by the parent, so to eliminate the effect, I have a debit entry to dividend income. Please note that it is the amount coming from the parent's separate financial statements as my starting point that I adjust. The dividend declared that I credit is to eliminate the original debit entry of dividends declared by S. And now you can see that in a consolidation journal entry, again, I can have a line item of the parent eliminating against a line item of the subsidiary. And that's because I have P and S added together, and now I'm adjusting that combined totals for purposes of the consolidated numbers. But when I have a dividend that was declared and not yet paid, there's also a shareholders for dividend and dividend receivable balances that I have to eliminate. And that is what the second journal entry is for. It's again a consolidation journal entry, so I have to adjust The subsidiary has a shareholders for dividends liability, a credit entry that I now have to eliminate through this debit to shareholders for dividends. And the parent, coming from the separate financial statements of the parent, there's a debtor dividends receivable. To eliminate that debtor, I have a credit entry dividends receivable. Again, it's the shareholders for dividends from the subsidiary that eliminates against the dividends receivable from the parent. It's combined balances and totals that I adjust, and the amounts I'm adjusting for comes from the separate financial statements of P and S. If there was a dividend applicable here to the value of 10,000 Rand, the 10,000 Rand would have been eliminated against other income and dividends declared. Because it's a wholly owned subsidiary, the full dividend declared by S was declared to the parent. And then the full shareholders for dividend will also eliminate against the dividends receivable. Still looking at intragroup dividends declared by a wholly owned subsidiary, let's see what the consolidation journal entries would be if the dividends were declared and paid during the reporting period. When the dividends were declared and paid, it means that the parent company recognized dividend income and the subsidiary recognized dividend declared. But the shareholders for dividends and dividends receivable will no longer be recognized in the separate financial statements of P&S at the end of the reporting period, as the liability has been paid and the debtor has been received. If you know that, and that's why it's so important to understand what happened in the separate financial statements, it makes it easier to understand what you want to achieve through your consolidation journal entry. As I've said, the parent did recognize dividend income and the subsidiary did recognize a dividend declared. So the consolidation journal entry that would eliminate that effect is again a debit to dividend income of the parent and a credit to dividends declared or paid by the subsidiary. Again, I am adjusting combined totals. That's why the consolidation journal entry has one leg adjusting an amount from the parent and another leg adjusting an amount from the subsidiary. If the subsidiary declared a dividend of 10,000 Rand, because it's a wholly owned subsidiary, the full 10,000 Rand will eliminate against the dividend income or other income line item in the consolidated statement of profit or loss, and dividends declared will be credited in the statement of changes in equity. You will now note that we do not have the second consolidation journal entry where we eliminate the shareholders for dividends against the dividends receivable. And that is because those two balances no longer exists in my starting point, being the separate financial statements of the parent and the subsidiary. Because it has been paid, because the dividends were paid, those balances no longer exist. If they don't exist, I do not have to eliminate them.